Hello. So it looks like we still have open question on when our lectures start. And still, most students, I believe, believe that it starts at 6:10. I have just several versions from the university. But we'll start at 6:10 today, as the last time. And by the way, while we're waiting for the others, uh, I was playing with my equipment today. Could you tell me or write? Can you hear me okay? Okay. Because I decided to present myself a professional studio equipment, but I didn't have time to learn how to use it. So it can be better than before, but it can be even more worse because of all settings. Yeah. Next week it will change to the worse, because next week I'll be lecturing from Khanty-Mansiysk, I believe, and I won't have any external equipment except my notebook there. Okay, let's get started. Not many of you are here, but I don't think it's very important because the main part of your work anyway goes outside the lectures with your models. Those who were interested in lectures are here, I believe. Well, last time we discussed the financing part of the project. Now we have a complete budget for this project. We have our we have our capital expenditure, operating expenses, our sales, financing. We have actually a complete budget for this project. And this part is finished. And even without any further analysis, you can see a lot from the part that we've done. Because from this model, you can see that, for example, we have enough cash. You can see that we managed to repay our debt, which means that we have enough income from this project to repay this debt. The only thing that we actually don't see for now is what this project means for the equity holder. So for the bank, you can see anything you have to know about this project from these two lines. You can see how much debt this project needs, and you can see that this project is able to repay this debt. So for the bank, this is an efficient project, profitable enough to repay its initial investments. But what's for the shareholder? And what we can see for the bank from the budget, we cannot see directly from the budget for the shareholder because we don't have any line in our budget that would mean repayment to the shareholders. Yes, we have some line important for us here. You can see from this line, from this fact, that after 10 years of this project, is it 10 years? Yes, it's 9.5, about 10 years. After 10 years of this project, with initial investments of 2 billion rubles, and after repayment of debt we used in the project, the shareholder still holds about 8 billion rubles. So the project looks, even from the first side, this project looks pretty profitable. For 10 years, from 2 billion to about 8 billion, it constitutes quite high income for the shareholder. But it's not always the case that we can guess from the number, this number, that the project is profitable enough. And sometimes the risk for the project is also very high. So expected profit, expected return, expected profitability of the shareholders' investments must be much higher. So this information isn't enough for us. And of course, anyway, we're building a model. So we're going to formally present the result of this project. Well, how do we calculate profitability for the shareholder, or just general profitability of the investment of the project. We calculate discounted cash flow indicators. The three things we calculate for, right, like any project are NPV, net present value, internal rate of return, IRR, and discounted payback period. But actually, in my model, I will not calculate discounted payback period. Instead, I will just build a payback chart, because from this chart, you can easily see anything you need to know about the payback. And the chart, the visual form of this calculation is more convenient for the presentations reasons. Okay, let's start with just straightforward calculation used for NPV or IRR. We go to our analysis worksheet. Let's add in the beginning of this sheet another table. In this table, we will calculate our DCF ratios, DCF analysis. And the first thing we need is maybe the discount rate. Or we can start with something else, with the cash flow for the discounting. Maybe let's start with the cash flow. Okay, free cash flow. And here we have the first big question. What cash flow we use for our analysis? We have in valuation, we had two different types of cash flows: free cash flow to the firm and free cash flow to equity. Free cash flow to the firm was the free cash flow the whole company has to repay to its investors. And those investors are, generally speaking, debt holders and equity holders, right? If it's free cash flow to equity, then we exclude from this free cash flow cash used to repay to our debt holders, and we just analyze the cash flow remaining for the shareholders of the company. Let's start with free cash flow to the firm. Or FCFF. How we calculate it? It's equal to, and we go to our result sheet. We need our cash flow statement. And in the cash flow statement, we start with cash flow from operating activities, but we don't subtract from this cash flow our interest paid, because interest paid is something that we paid to our investors. And we're going to analyze free cash flow available to pay to our investors, right? So just like we did it with CFAs last time, we subtract the interest paid. But in contrast with what we did last time, here we should change something. We're going to analyze that's not exactly the cash flow. That's economically available funds. And economically available funds from this project will change if we stop paying to the bank, for example. If here in this line we have 118 and we stopped paying those interests, what will happen? Those 118 million rubles will be removed from our income statement. And in our income statement, our profit, taxable profit, will be 118 millions higher. So we'll pay some tax on profit, right? Income tax. So actually, when we remove this loan from our budget, our cash flow will not increase by 118. Instead, it will increase by 118 times 1 minus tax rate, right? And our income tax rate is here. And you can probably see that something is wrong with this calculation, because in this cell, I assume that if I stop paying this 118 million rubles, then I will start paying new income tax. And this income tax is equal to 118 million times 0.8, or 1 minus 20%. But the problem is that if we check our income statement, you will see that we don't have any operations in this period. If I exclude interest expense from the income statement, actually no tax will appear, right? So this is the first problem with FCFF in my analysis. This assumption is true for any ongoing business, ongoing and profitable business. If you change something in its interest expense, it will automatically change tax expense, right? But in the project like this, where we have several periods with no income, that will not be the case. But we cannot exclude this part because, and this is a question for you, maybe somebody has an answer. Where do we use the same multiple? 1 minus tax rate in our discount cash flow analysis. Do you remember? Maybe from valuation?
Depreciation. Maybe depreciation cost.
No, in WACC, in weighted average cost of capital. And weighted average cost of capital, if you remember that, I guess most of you were on my or somebody else's courses on valuation, right? If our cash flow is FCFF, free cash flow to the firm, then our discount rate is WACC, weighted average cost of capital. And for weighted average cost of capital, we will be using this multiple. So if we put tax rate in our discount rate calculation, but don't put it on our free cash flow calculation, then we'll mess up everything. So we cannot simply remove it from here. Although we understand that for the first 3 periods, that's not absolutely correct. Okay, let's finish this with our FCFF. The last part of FCFF is our cash flow from investing activities. And now we have a complete number for this line. Okay, so we have negative values during our investment phase. Then during operations, we have positive numbers, and that's what we do for our discount cash flow analysis. Now, the next line we need, discount rate. And maybe let's start here with some number. I will return to that later. For example, we started with 15%, and we just use the same rate for all periods. Now, to calculate net present value, for example, we have enough data already. So we have the cash flow to calculate discounted values and the discount rate. But as I said at our first lecture, we will not be using NPV function. Instead, we'll calculate that manually. That's important because with these calculations, it's very important to show how you calculated everything for these indicators, because there can be various assumptions behind those calculations, and it's much easier to communicate your position if you calculate it manually and you showed every step of your calculation. So the next part is discount index. And here we simply accumulate our discounting. Now, my assumption is all the cash flows in my financial model go to the beginning of every period. So if the cash flow is in this period, that means that all these cash flows are on 1st of July of 2022. And that assumption means that my discount index will be 1, exactly 1 here. In the next period, what will be my discount index? It will be the previous value over 1 plus discount index or discount rate, but not the discount rate of this period, discount rate of the previous period. Because in 2023, again, all our cash flows are on the 1st of January. So discounting of 2023 didn't influence this number, but the discounting of the previous period influenced it. So it's 1 plus discount rate, and we should take into account the actual length of this period, because this period isn't a year. So we add the power of, and we go to macro, number of months times over 12. We can add something like anchors here. That's it. So we have the discounted index. And the last step is our discounted cash flow. Actually, not the last, but we're close to the last. Discounted cash flow is simply our cash flow times the index. Now we can accumulate those numbers. It's equal to what we had plus new cash flow. And this last value is just our net present value, right? So the net present value is equal to this. Okay, so the project looks profitable now. We can, of course, spoil it quickly with action like this. And you can see from that we still have one question. Okay, with 15%, it's profitable. With 20%, it's unprofitable. What's the right value for the discount rate here? And as I said, discount rate for the cash flow based on FCFF is our weighted average cost of capital, WACC. So let's add some lines here and let's try to calculate WACC for this project. I believe you remember the formula. We have cost of equity cost of debt share of equity share of debt and now WACC is, let's fill something here. For example, 20% for equity. Cost of debt was 10% as far as I remember. Let's check it. Yes, it's 10%. 10%. And let's say that we have 25% of equity. We'll return to that. And can actually set it as calculated 1 minus share of equity, 75% share of debt. And our WACC is cost of equity times share of equity plus cost of debt times 1 minus tax rate times share of debt. So this is our WACC, and we can simply link it to the WACC. Okay, that makes our project even more profitable. So everything looks okay. The only thing now we have here is the question about these numbers. Okay, with cost of debt, I feel pretty comfortable with this number because we've taken it from our actually used loan. Okay, cost of equity. Let's say for now that's 20% is good enough for our project. What about the share of equity? With share of equity, we have a problem because actual share of equity in our project will be looking like this. Let's calculate it. We can calculate it from our balance sheet. Our total equity is here. Total equity over equity plus debt. We exclude accounts payable from this calculation, by the way. Okay, it's 44%. Oh, we can change it to 44% here. But then we continue and we can see that at some moment it's 7%. At some moment it's 100%. With 7% here, we have a highly profitable and very attractive project. With 100% here, we have very unprofitable and unattractive project. What would be the right value for us? What do you think? Where should we put the numbers? %, the lowest, 100%, maybe average, maybe weighted average. How do we calculate share of equity for our formula? I'm pretty sure you know the formula, so you have to apply it somehow to this project. Any idea? So it's hard to choose, actually, right? It's hard to choose, and there are total owner's equity over total loans. Okay, total owner's equity. You mean total invested equity, right? Because the owner's equity, because the owner's equity here is very low. But total invested equity is 2 billion rubles. Total loans is something like 6 billion or 8 billion, right? It was 6 billion rubles. Yes, we can use things like that. That will give us something about what we started with, which is 20%, 25% of equity and 75% of debt. But the problem is that, look, what if I change the schedule of debt repayment? Will this project be different for the shareholders? Will be the difference between, for example, an idea like this. Let's go to our financing. It was calculated automatically, but what if I change it, for example, to something like this? I'll save the model just in case I'll break everything. So sorry, not here. I will remove my loan now. I remove my equity. And now look what I do. I need some money here. I remember that it's about 6 billion rubles. What if my schedule is like this? 6 billion. Then 2 billion here. And, or maybe I need 7 billion here. Yeah, 7 over 2. But the change, the main change in this version is that the total amount of the loan and the shareholders' equity is the same, about the same. But the order has changed. Now I got my loan. I didn't invest anything as shareholders' equity. I started the project with this debt, and only later I invested something as a shareholder. Will this cash flow be more efficient for the shareholders? Of course, it will, because the total amount invested is the same, but the schedule is different. And with this different schedule, expected income for debt and equity is different as well, right? The discounted equity invested against total loan. The problem is that if you have discounted equity, with what discount rate you'll be discounting it? We're trying to calculate our discount rate. We don't have it yet. This is the problem. So actually, there are, let's, okay. Everything's restored, yes? Yep. There are two approaches used for this issue. One is economically, theoretically correct. Another is incorrect, but people use it anyway. So for the first thing, for the first idea, for economically correct version, we start not with the mix of capital for this project. No, we ignore this mix absolutely. Instead, we think about normal mix of capital for business like this. And if we said, for example, that for projects like this, share of capital, 25% equity, 75% of debt is something that we can hold stable for our business. Then we use this mix. And with this mix, we calculated then weighted average cost of capital for this project is 11%. Now, in my model, we have different mix of capital in every period. I have a question. What should change in every period? Should it be weighted average cost of capital, or maybe it should be cost of equity? We know for sure that cost of debt is fixed. It's fixed in our contract with the bank. But if our capital mix is changing, what should change for this project? Should weighted average cost of capital be stable and always equal to this normal WACC? Or should cost of equity, that is required profitability for the investor, change? Do you remember the theory that supports the answer to this question?
May I try to suggest something theory?
Yeah.
As far as I remember, WACC is a rate, discount rate, right?
Yeah,
For
they
our-
all discount rates, yes.
For our company, for profit, and the cost of equity is a required rate for investors.
Yes.
And investors want to have profit, and I believe we need to add this discount rate for cost of equity. We need to change cost of equity.
Cost of equity.
Yeah.
So the cost of equity will be, so we have always 11% here, right?
Yes.
And cost of equity for different periods will be different, and this value will be changing so that in each period WACC will be 11% again. No matter it's 44% of equity or 7% or 100% of equity, right?
Yes.
But what is the name of the theorem? I believe you can recall it. It's one of the most important theorem in finance.
Discount.
No, Modigliani-Miller. It's Modigliani-Miller theorem, and this theorem states that if you have an investment, in our case it's investment project, then the required return for this investment does not depend on the mix of capital used to realize this investment. And the explanation for that is very simple. We know that required return depends on risks, right? And risks are properties, are options of the project, not of capital. So it doesn't matter, will we finance our project with 100% of equity or 20% of equity or whatever. Its required return for the project will be still the same. And that means that WACC should stay the same. The problem with that is that theoretically, it's absolutely correct. And this is the right way to do it. But this theorem, although this is the most important theorem in finance, it's based on some assumptions. And those assumptions are, in fact, they are simply not true. One of the most important assumptions is that for Modigliani-Miller, there's no bankruptcy in the world. No taxes, yes, also. No taxes, but actually Modigliani-Miller can do with taxes, because if you remember, there are two versions of Modigliani-Miller. Modigliani-Miller without taxes and Modigliani-Miller with taxes. But Modigliani-Miller doesn't do anything to the problem of bankruptcy. So actually, in fact, in real life, capital structure changes risks of the project. In fact, so that's not completely the truth, and that's why people not always, actually not often, use this idea that WACC should be stable for the whole project. That can be your approach. You can say that we use some expected stable mix of capital, like here, 25 to 75, and we'll calculate WACC based on this mix of capital, and we'll apply this WACC to our cash flow, although this cash flow actually relates to very different numbers in the mix of capital. So another possible approach is that we can say that, you know, actually our shareholder, the shareholder who stated that the cost of capital for this project is 20%, that is expected profit for this shareholder is 20%. They knew all this information. They knew that the capital structure will be the following. And they said they expected profit based on the fact that this project has this profile, this capital profile. So because of that, this 20% is the correct number for the whole project, and we should not change anything here. But if we don't change anything here, that means that we should recalculate weighted average cost of capital in each period, right? If it's always, if this number is always 20%, okay, it's 20%, that's always 10%. But the share is changing, and that means that we'll have different WACC values for each period. And that's one more reason why you should calculate net present value manually, showing all your discount rates, repeating them in each period, because you can get an investor who will require calculation of weighted average cost of capital for each period, stating that cost of equity is fixed, it's constant. And for example, among Russian well-known institutional investors, WEB, which is Внешэкономбанк, but now it's not Внешэкономбанк, it's just WEB RF. one of Russians, it's not bank actually, it's like a development agency. It called bank, but it's a development agency. And they require for their models to calculate WACC in each period based on the mix of capital for this period, just because they decided to use this assumption. You cannot prove that the first assumption based on Modigliani or this assumption is more correct. They are just two standpoints to analyze the project. But if you choose the second assumption, if you say that, okay, cost of equity is something that my shareholders want to get, and they decided to have this discount rate in each period, then probably we have an easier way to deal with that. To do that, first let's just finish with some calculations here. Internal rate of return. Do we have formula for the internal rate of return? No, we don't. Because we have just equation. Internal rate of return is the discount rate that sets our net present value to 0. We cannot calculate it with any formula. So instead we use the formula from the function from Excel that helps us to calculate it. But in financial models, when you calculate something really quickly with several numbers, you can use IRR function from Excel. In a serious financial model, we always use XIRR. The difference with XIRR is that in addition to values, and our values, just because many people do this mistake, in IRR function, we use free cash flow before discounting because the function will discount it. So the first line is our values, and the second is dates. And we go to macro and use beginning dates for each period. If we didn't use these dates, we would have a problem because our first period, the standard IRR function, works as if each period is a year. But in our model, sometimes each period is a quarter. Sometimes, like here, the first period is 6 months, and then we have annual model. And XIRR function deals with that very easily. So we can see that we have internal rate of return 15.9. Let's check it. If we put 15.9 here, yes, we get NPV about 0. So it works. Okay, I'll return later to payback period. First, let's look at the same calculations, but now if we decided that the shareholder ignores this capital mix and always use a stable discount rate, maybe we just need another version of these calculations. We don't need this. Now, our shareholder simply has required return, and our free cash flow will be our free cash flow to equity. FCFE. Now this here, the discount rate is just a copy of this discount rate. Okay, all calculations here correct. Okay, discounted cash flow will be calculated from this cash flow and we then accumulate it. Well, the last step we need here is we need our free cash flow to equity. Free cash flow to equity is equal to the cash flow from operating activities. And now we don't subtract anything from this cash flow because interest paid, yeah, interest paid to the bank. And now we look at our project from the standpoint of the shareholders. So what paid to the bank is just the same as to something that paid to our suppliers or employees or whatever. It's just some cash outflow of this business before we have money available to investors, to the equity investors. And the second part here is, of course, investing cash flows. Look, our cash flow has become a bit simpler. We don't have this unpleasant question about tax rate. Now we have just cash flow available to the shareholder. Oh, sorry, I've lost a couple of lines. Of course, this cash flow should include only investments covered by the shareholder, and it must include only free cash flow remaining after we repaid our debt to the bank. So two other lines from our financial cash flow: proceeds from borrowing plus repayment of debt. Now you can see that we have minus 2 billion rubles. It's automatically equal to the numbers we had in our cash flow as equity inflow. Then it will be 0 here because yes, we had some capital expenditure, but it was covered with debt. So for shareholder, just nothing happened. Here again, nothing happened. And here we have some money because we had DSCR greater than 1. That meant that we leave some money not paying anything we have to the bank. And in the end of the project, we have very high cash flow because we repay the debt. So we don't spend money for the bank, and all income of this project is now available to the shareholder. You can see that this number and this number is equal here because we stopped paying to the bank. Okay, so what we have for the shareholder: less investments, less money while we're paying to the bank, more money at the end of this project, right? Here we have incorrect macro because I didn't fix it. It's 5, line 5. Line 5. And you can see that for 20% discount rate, this project is profitable for the shareholder. Everything looks good now. And what we've done with this change here, that will be DCF analysis, FCFF, and that will be DCF analysis, FCFE. What we've done, we moved from the assumption that Modigliani-Miller stands to the assumption that the shareholder has fixed discount rate, fixed required return. We actually have hidden this issue from our calculations because we don't see any question about capital mix in this calculation, in this profitability analysis. So for investment projects, for projects with variable capital structure, the second approach would be actually more comfortable for most cases because of this conflicting assumptions, because it's easier to explain the shareholder that this cash flow is their free cash flow. This is what they get from the project or what they invest in the project. So for the investment project, I would recommend always calculate this second version. And sometimes you can calculate the first one. Sometimes you completely remove it from your calculation just to avoid explicit demonstration of this issue with capital mix, change in capital mix. Okay, but what if the project is actually quite risky and required return for the shareholder here is 30%? Do you think that this project now should be declared unprofitable and should we reject the project? Is it possible to accept the project with results like this?
No, because PV is negative.
Because what?
NPV is negative.
Yes, NPV is negative, but we can change it. Look, I'll add some lines and then I'll go to my reports. The first very simple idea, I go to my financial reports, to the balance sheet, and in the balance sheet, I will look at this number. Well, look, that was a cement plant. A cement plant is a building with quite heavy equipment. I bought it and used for 7 years. And at the end of my project, what I have, what the shareholder has, they have the money they received from the project, and I analyzed this money. And I see that this money doesn't create actually the return they expected from the project like this. Yes, that's true, but that's not all they have. In addition, at the end of 2031, they have a plant with value of fixed assets equal to about 3 billion rubles. Does that mean something? I believe so, right? So the first thing, the first assumption I can make is that maybe I can sell this plant at the end of my project. So I decided that my project is 10 years. Okay. But after those 10 years, what will you do with the plant? Maybe you can sell it. What if you can sell it with the price equal to value of its fixed assets? That looks pretty plausible. It's possible to sell working business for such a price. I don't know what how good was my forecast for depreciation period. I'm not sure about fair price for these assets, but on average, when you have a working business, fair value of its assets usually is lower than the fair value of the whole business. So in most cases, I can sell this plant for this price. So the first assumption I make is that net assets, we use the term net assets because if I had in this period, if I had in this period some debt, then after selling the plant, I would have to repay this debt. But I don't have any debt in this project because my project period, my forecasting period was until I repaid the debt, right? So I don't have debt here. That's why my net assets will be just equal to these fixed assets here. And the same way, I don't add cash to my net assets. Although for a company, when we calculate net assets, it's all total assets minus debt. But here I exclude cash because I already used this cash in my free cash flow analysis. So although the cash remained on the accounts of the company, I counted this cash as if I used it. So I don't add cash, I just use my fixed assets. But I will call it net assets because it's a very well-known term for business valuation. I will explain why we calculate the terminal value. It will be our next step. So the first assumption is that after this forecast period, I will sell this business just as a bunch of assets. So I terminate the business and sell the assets. In this case, my net assets in the end of the project will be equal to this one, right? Then, but I will get this money not here, I will get it here, right? So I calculate discounted net assets, which is this times my discount index, which I calculated here. And this discounted net assets is like terminal value based on assumption that I terminate the business and sold it as a bunch of assets. And that means that NPV plus net assets is equal to this. Still negative, but not that bad, right? So actually, this project would have like maybe not 30, but 29%. 28 give us, yeah, it's 28.9. About that. It still looks bad, but not that bad. We can think about project like this. Roughly speaking, the shareholder gets what they expected, right? Now, let's make another assumption. Another assumption would be this business will continue, and after 10 years, I have a choice. I will either sell it to the shareholder like me, to a shareholder who will value this business based on the same assumptions, with the same discount rate and so on. Or maybe I will keep this business. I didn't model it. I didn't build a model for 30 years or for 50 years, but I understand that this business can work more than 10 years. And I will add some terminal value based on expected profits after these 10 years. You just meant it. Terminal value based on discounted cash flows. Okay, so for the terminal value, you must know the formula. Yes, for terminal value we have some growth rate. Discount rate will be the same as here, the same 30%, and some annual income. Let's start with this annual income. I will call it for reason, this annual income. We don't have a line called annual income, but we have actually different explanations of what annual income for this project is. So annual income after this project forecasted period will be, let's start with a very simple assumption. We used free cash flow to calculate the profitability of this project during these 10 years. Well, let's just take this free cash flow as our annual income. Okay, then growth rate. We had inflation. Let's be very conservative. Let's say that our growth rate is equal to the inflation in the end of our model. It's 4%. Growth rate, discount rate is simply what we use here. Now, terminal value. The terminal value will be calculated as this annual income times 1 plus growth rate, because we need the income in the next year, over the discount rate minus growth rate. This is the formula you know from Gordon growth model, from all models with constant growth rate. So this is the terminal value. But this is the terminal value again at the end of 2031. So we need the discounted terminal value. Times discounting index. Now it's more than 1 billion. And of course, if we add it to our net present value for the first 10 years, then we get NPV plus terminal value that's positive. Now, taking into account all future expected income, we can see that this project should be profitable for the investors. Yes, they will not get repaid for their initial investments in 10 years. But if they sell their business at the end of forecasting period, or if they just hold it sometime after those 10 years, they will be repaid. The project will be profitable. Does it look correct? Or I will put it the other way. Find an error here. What's wrong with that? And by the way, that would be correct if we applied this approach, for example, for a public company analyzed in our valuation model. But for the investment project like this approach is completely incorrect. What's wrong with that? Okay, you don't see it yet. This number, annual income. So in my free cash flow to equity in 2031, this annual income, what I called annual income, was actually free cash flow to equity, and this number was absolutely correct. Everything was okay with this number. But I cannot use this number for my terminal value because the terminal value is based on the assumption that I will repeatedly receive this income in all future periods. And now let's go to my cash flow statement. And let's see how I got this number. But this is actually a very simple number. This is just net cash flow from operations, right? And this cash flow from operations is pretty high because in 2031, we just repaid all debt. So we don't have to pay in this year, we don't have to pay anything to the bank. right? And we don't need to invest anything because we invested a lot in the beginning of the project. But will this equipment last forever? Or maybe after some time, we will have to replace some equipment. Then after some time, we will have to reinvest something in our buildings and structures. We will, right? Somewhere in the future, we will have to repeat this part. And I can actually guess about where in the future we'll have to do that. If we invested this like 16, why is 16? Is it actually 16 billion? Oh, sorry, I checked it in the balance sheet. Yeah, this 8 billion. If we invested these 8 billion rubles here, and in my project assumptions, in capex part in fixed assets, I used information that my depreciation period is 10 years, then maybe after 10 years, I will have to invest in this equipment again, right? That's not completely true, because our depreciation period is usually shorter than the actual economic life period for this equipment. But maybe after 15 years, I will have to invest new 8 billion rubles just to keep this business working, right? But I didn't show this in my analysis. In my analysis, I used this annual income as something that will stay there forever. That's not true. In fact, I will have to reinvest something regularly, so I cannot get this annual income. And that's why, for most cases, in an investment project, if you use terminal value based on the same free cash flow as you used in your forecast period, then you will overstate the efficiency of this project. So you should be very careful with that. What can we use instead of this? We can use the term, the value called, let's put it here, no plot, or another term for that, no pot. Net operational profit less adjusted tax, or just net operational profit adjusted for tax. Just different terms, but the same formula. What's no plot? It's equal to, and we use the last period here, to EBIT. So the numbers, the profit we had before we paid any interest, just in case we have one, times 1 minus tax rate. What is the difference between this no plot and this annual income based on free cash flow? The main difference is that in no plot, we subtracted depreciation. So we made an assumption that depreciation isn't something that just came from our accounting. We made an assumption that depreciation is a part of our cash flow. So we invest every year amount of money equal to our depreciation, just to keep our assets sound, to keep our business going. And that's why this number is less than our first version. Okay, if we set it equal to this one, we still have a positive number here. So the project still looks profitable and we can invest in this project, but our calculations now are more accurate. But you should be careful even with this approach. So no plot is a more correct one, but you can set such parameters for your project that even no plot will stop working. Let's go to the project and let's set for this equipment, for example, the depreciation period 6 years instead of 10 years. And let's imagine now that this equipment is actually for 6 years. So after 6 years, it will be good to replace it. Look here, what happened now? After 6 years of depreciation disappears from our calculation because these assets are totally depreciated and we don't have any value to depreciate. And what will happen to our analysis? Again, we have discounted terminal value more than 1 billion, and our no plot again is close. It was 2.8 billion, 2.76. And we have the number close to this free cash flow. Why? Because not just investment disappeared from our cash flow, but also depreciation in the last period disappeared from our income statement. And although this case, these parameters mean that our cash flows should be lower because it's time to replace the assets exactly in the end of our project. Maybe in 2031, we had to put new investments, or we had to expect new investments in 2032, somewhere there. Usually we don't put reinvestments in the end of the model. We make assumption that this company can work one year after the full depreciation. Maybe they will still have some time to work, but they cannot continue forever with these numbers. And without depreciation in the end of the project, again, we have incorrect calculations. So this is a very important thing about terminal value. Terminal value that works absolutely for valuation models, for models based on historical reports that we forecast into the future, and those reports have stable level of capex, depreciation, everything. So our forecast is pretty stable as well. That's not the case with the investment project. In a project finance model, we start with lump sum of investments of capex. Then we invest nothing. And by the end of the project, by the end of our model, we usually have nothing as capital expenditure, but that doesn't mean that this company can work more, that they can work longer without these investments. So you should be very careful. Yes, I'll answer that now. Again, why this approach will be correct for a public company? Because in a public company, you don't have, look at this. Look at this spot. Do you see something like this in a valuation model for a public company? Do you see something that like we invested for 3 years, huge amount of money, and then we just stopped investing? No, they are all ongoing businesses. They consist not of one project each, but of dozens and hundreds of projects. Their investments of those projects overlaps, and that's why they have some stable level of capital expenditure in your model. This is the main difference between a public company that we analyze as something like we take 3 years of history, then we take growth rate, some other rates, and with those rates we forecast this history into the future. And if it was a public company, we would have something like this. If we have this amount of money here as investments, then probably we will put something like, I don't know, sometimes we have some outliers as investments, but then we have something stable, like, I don't know, 1 billion each year. And with this 1 billion each year, we have our valuation model. And this 1 billion each year, we use these investments to replace depreciated assets and to invest in our growth, something like this. And that means that by the end, in the last period of your model, you will have free cash flow that actually can support these companies' operations forever, because of this stable reinvestments, but not in an investment project. In an investment project, we modeled our startup investments, then we model our operations with no investments, and we cannot just take the last period and forecast it into the future. No. The good approach would be something like taking this whole 10 years period and repeat it several times. But that's also not completely true, because we usually have some time that we can work with this initial investments. Our reinvestments will be lower than our first investment, and so on. Our dynamics here will be different. Our operating cash flows for the last period are a more correct approach to calculate our future income, and so on. So this is the main difference. Business valuation model is something that repeated every year, more or less stable. But project finance model has the beginning of the project, the operating phase, and we cannot just repeat this operating phase forever. So the second version of our terminal value is that we apply no plot, for example, Oh, we actually have another possible approach. You in your project, you can add reinvestments, and you can forecast your regular investments necessary to support this business, to keep it working. If you do that, you will come to the same model as for business valuation, but people rarely do that. Usually you will see a model like this with investment part and operations. The last possible approach, we actually have another one, is the following. Okay, what if I don't want to think about my possible annual income and so on. Instead, I understand that by the end of the project, in the beginning, it was just an idea, right? Here in July 22, it was just an idea. It wasn't a business. So I analyzed it as an idea. But here, in the end, this is a stable business. In my case, is a stable cement plant. And maybe I can imagine that I will sell this plant, and I will sell it based on market multiples. For example, I know that for businesses like that, price to sales is something like 1.5. If so, then value, this terminal value, of the company is equal to our sales in the last year times this multiple, isn't it? I have an established business with sales, with history, with everything. Then maybe I can just sell it just as any other plant. The discounted terminal value is calculated the same way we did it with the other versions. And then NPV plus terminal value is again the initial NPV plus what we got here. So that's another possible approach to the terminal value. We have these three styles for our terminal value analysis. You can apply them all. It depends only on the version that you believe the closest to the reality. But when we analyze the project, any project for equity holders, we usually add this information about terminal value. The reason for that, why we not never, but very rarely analyze capital investment project based just on these forecasted cash flows, because the limit that we usually use for our forecasted period is based on the requirements, the needs of the bank. So we usually build financial model until the moment when when we repaid the debt. But that doesn't mean that this project stopped for the shareholder. And that's why we always have this tail of value, and we analyze this tail with one of these three approaches. Of course, terminal value based on discounted cash flow is the most popular, because this is the same approach as we used in the main model. We calculated net present value based on discounted cash flow, and we use the same idea for the terminal value. But you have these two possible options. Here you can use any multiple you have: price to earnings, price to sales, price to EBITDA. Price to EBITDA we usually use enterprise value for EBITDA, EV to EBITDA, not price. And although for this business we don't have debt, so price to EBITDA is equal to EV to EBITDA. But this is just not very good idea to use it here. But price to sales is possible thing, and this is how sometimes it's done. And we will be discussing very similar ideas when we'll have a lecture on venture business and on valuation of venture business and or analysis of venture models. Okay, that's all for today. That's what I plan to tell you. And if you have any questions, you can ask it now. Or if you have maybe questions about your models that you want to discuss now, we can do it now. Okay. Looks like we're done. So see you next Friday here for the lecture, and please make sure that you have enough progress with your models, because we don't have much time to finalize everything. Some of you moved too far, quite far. That's good if you move far, but for most of you, I expect you have a lot of things to do with the models. So bye. See you next Friday.